USD JPY just touched 160. And if you trade Forex, you know already what that means. We have covered that multiple times in our weekly outlooks and even in the Wednesday live trading sessions. But what most traders are completely missing is what happens at 160 is not going to just affect the yen. It can drop S&P 500, it can crash crypto, and it can blow out stock traders who had no idea that Japan was even relevant to them. So in this video, I'm going to break down exactly how that works. We're not using any indicators. We're not looking at any extra noise. There's no predictions. I'm simply stating the actual macro mechanics that the institutions are using to read the setup. So by the end of this video, you'll understand the yen carry trade, why USD/JPY at 160 is a global risk event, and exactly what I'm watching for the week of June 16th. So let's get into it. To understand what's happening right now at USD/JPY sitting at 160, we need to go back to the beginning of this cycle. Japan has already intervened into the currency market twice in 2026, spending approximately 10 trillion yen, that's around 65 billion US dollars, buying yen just to stop the currency from weakening further. At each intervention, with the first one, we had a drop down for about 300 pips. The next drop that we had was about just north of 500, sitting at 571 pips in USD/JPY. These were fast, violent moves with no warning whatsoever. And both times, as you can see, that the pair has climbed right back up. So that should tell us something very critical. That Japan's intervention is not solving the problem here. It's simply a speed bump and not a real solution in the market. The reason that it keeps coming back is the same reason that I went back up in the first place, which is the interest rate differential between the US and Japan. And right now that sits at about 2.74%. That number right there is the engine behind everything that I'm about to show you right now. And if you've ever asked yourself why Forex moves can suddenly crash your stock positions, your crypto, or any other portfolio positions, because I have asked the same exact thing, then this video is going to answer that question completely. Before we dive into the actual technicals, I want to take a second to explain a very important market mechanic concept here, which is the yen carry trade. Because once you understand that, the connection between USD/JPY and your stock portfolio is going to become immediately obvious. So the mechanism is pretty simple. Starting off with Japan's interest rate, which is essentially sitting near zero compared to the rest of the interest rates globally. The US pays around 5.5%, so that's a spread of roughly 2.74%. So what do institutional funds like hedge funds, pension funds, or sovereign wealth funds do with that information? They borrow in yen and they borrow at a very cheap rate, and then they will deploy that capital into higher yielding assets like US tech stocks, treasury bonds, emerging market debt, anything that essentially pays more than zero. So that is the carry trade. And the scale of this is not small at all. We are talking trillions of dollars in institutional positioning built around this one mechanism. So the reason why this can become very dangerous is exactly what we're looking at right now. When the yen is weakening, USD/JPY is going up, and those trades are profitable, right? The borrowed yen now is essentially worth less. The US assets are worth more. Everyone's happy. But the moment the yen suddenly strengthens, either Bank of Japan intervention or a surprise rate hike are usually the main catalyst here. Those same funds now have to unwind. They have to sell their US equities to buy the yen back, and it happens pretty fast, as you can see, all at once. And we saw the exact thing happen here back in July 2024 as well. Japan intervened right at that 160 mark, and USD/JPY dropped 20 figures in days. We also saw that Bitcoin dropped 30%. Let's go ahead and pull up that chart as well. Back in July of 2024. Right here with that insane drop down for about 30%. S&P 500 also dropped around the same time as well from that corrective move from the April, and then bringing it all the way down. You had an insane push up after that, and this is the corrective move from July that happened. All of this happened in days, as you can see, not weeks, not months, nothing like that. So you can see how volatile and fast these moves end up happening. And none of those moves were because of bad earnings, not because of weak economic data points that came out. It was because of currency intervention in Japan. So this is the point that most retail traders never understand, because they see their stock positions getting hit and they have no idea that's connected to a yen trade that they never even made. So why are we back at 160 today? As you can see here, we've already tapped into it twice. We're coming into it the third time. There's three specific things that converged here. Number one was the JOLTS opening data that came out from the US today, which came in massively above expectations, sitting at about 7.62 million, 7.618 million to be specific, job openings versus the 6.87 million consensus that we're forecasting. That's a beat by over 750,000 jobs. What that tells the market is that the US labor market is still strong right at the moment. The Fed has no reason to cut rates at all, which sends the dollar even higher across every major pair. And USD JPY, which is the most rate sensitive forex pair in the market in the world, responded to that immediately with that massive push up that we got, tapping right back into 160 at the market close. The second thing that converged here was the rate differential has actually widened now. 3 months ago, US and Japan policy spread was about 2.46%. Today, it's sitting at 2.74%. That gap is moving in the wrong direction for Japan. Every hawkish US data point is going to add fuel to the carry trade. Every weak Japanese data point is going to make it even worse. The third thing that we have here is Iran risk unwind that removed the safe haven yen bid. Earlier in the session, Japan's yen was strengthening because Iran suspended nuclear talks. Traders move into yen when there's any sort of geopolitical risk that rises. We know the yen as a safe haven asset. And then Trump posted that negotiations were continuing. So the risk off unwound immediately. The safe haven demand for yen also disappeared, and USD JPY pushed right into that 160 mark up top here. So we have three separate catalysts that are moving this pair, all pointing in the same direction, and that is exactly how institutional money moves. So you're not looking at just one thing, you're looking at a convergence of different catalysts. This is why I don't use indicators. Indicators are not going to show you the JOLTS data. They don't show you the rate differential. They don't show you the geopolitical risk flows that are happening, and they don't show you when all three are pointing the same direction at the same time. Now, the big question here is, will Japan intervene again? And the framework here is that the Japan officially says that they respond to excessive volatility, not a real specific price. They did say in the G7 meeting, the Japanese finance minister, they were targeting around 160. But just because price has now tapped into 160 does not mean that they're going to intervene immediately. But 160 does matter because it's the exact level where they have intervened before, and where the finance minister's credibility is basically on the line now. So the current move that we had from this 158 level after that previous break of the minor resistance and then the continuation up into 160 is approximately a 2% move. Historically, Japan has intervened after moves of about 8 to 12%. So based on speed and size alone, today's move is not large enough yet to guarantee any sort of immediate action. But the critical factor that changes everything here is that this is the third test of 160 in this cycle, ever since the beginning of 2026. When Japan spent about 65 billion US dollars and the pair came back to the same level twice, the market has basically now learned that intervention is not going to solve the problem here. And when credibility starts to erode, or it does erode, the next intervention has to be even larger and even more aggressive to get the same exact effect that we got the last two times. So the finance minister is already on record saying that bold action is needed, and the G7 has publicly backed Japan's right to act. The currency diplomat also called current moves extremely speculative, which is the diplomatic language that historically will precede the action here. Like I said, the moves in the past have been very violent. There's no warning, but we do have clues pretty much on the line telling us exactly what to expect. So the real risk assessment that we're looking at is that intervention is not guaranteed today, but it is now a live risk, and it can fire at any moment as soon as price surpasses that 160 or goes even above it with zero advance warning. So that is the single most important sentence for anybody that is holding positions right now. As soon as price pushes past that 160 level, you're sitting at a live global risk here. Now, the bigger picture here and the trade beyond the actual trade here is that the Bank of Japan meets on June 16th. Market pricing right now puts a rate hike probability of about 75 to 76%. If the Bank of Japan does hike about 25 basis points on June 16th, the rate differential will start to narrow from 2.74% to approximately 2.49% again. But that alone is not enough to structurally break any USD JPY to the downside. But combine that with the three simultaneously, a dovish signal from the Fed at their June 16th or 17th meeting the same day, and falling oil prices, reducing US inflation expectations, and now you have a genuine macro confluence that could push USD JPY from that 160 right down into that 155 or 155.5 level. So that is your structural move. And understand that this is not just a Forex trade. If USD JPY does drop 500 pips in a week because of Bank of Japan plus the Fed plus the macro convergence, the carry trade is going to start to unwind again. US equities that are currently sitting at these all-time high levels all across the board are very sensitive to any sort of mechanical selling from the yen-funded positions. S&P 500 has now closed out at its highest point, sitting at around 7,600. And that is the all-time high. This is the maximum AI concentration in the index. Yen carry trade fully loaded here. So I'm not calling a crash here. I'm just telling you the structural risk that is sitting live in the market right now. And in 2024, when this exact setup triggered, go back to the charts, you'll see the same exact drop that happened back in 2024. When this setup triggered here, the markets did not drift lower. They crashed in days, as I just showed you guys, through crypto, through S&P 500 to USD JPY. As traders, specifically as retail traders, our job is to understand the risk before it moves, not react to it after it has already happened, because now you have missed out on the move. So you're not predicting here, you're just understanding what the risks are and then looking at the different scenarios so you're prepared for those moves. Now, what do you actually do with all this information that we just talked about? If you're holding USD JPY above that 159 mark, this is your highest risk zone in the Forex market right now. Japan has intervened twice at this exact level in this cycle with G7 backing. A 300 to 500 pip reversal can happen in minutes with no warning. So your position sizing needs to reflect that reality. I'm using 1 to 2%. That's the only risk percentages that I stick to of my entire account size. If you're holding equity longs, very specifically, if you're looking at S&P 500, NASDAQ, or US 30, your stops need to be set here. And not because I'm calling a reversal, but because the carry trade unwind risk is structurally live while USD JPY is sitting at 160. So you need to know your exposure and you need to have your risk management pretty tight so then you're not wiping out your entire account and not even knowing why it happened. The highest probability setup, if the intervention does fire here, is you're not going to short USD JPY into the drop. That's the most common mistake from a retail side, and that's because of the volatility. The pattern repeated in every intervention episode since 2022, and you can go back and check it, is that USD JPY drops to 156, to 157. It'll start to consolidate out a little bit as you drop down to lower time frames. And again, like I said, come back and check it out. So you got your 156.5, you have your 157. It'll consolidate a little bit, and then it grinds back towards, as close as possible it can, towards that 160 level right here. Last time it tapped out at 158. And then you see that the carry trade will reassert. So without a permanent change in the rate differential, the carry trade always comes back, and the opportunity is to buy the dip at 156 or 157 after the intervention. Don't chase the short here. It's going to be very volatile, and you don't want to be stuck in the most common retail mistakes and they end up blowing out their entire account. So right now, we're not looking at any new entries. We're not chasing this. We're just watching what happens. Pure observation, and I do have my alert that is set right below this 4-hour zone that I do have mapped out. And that's simply to observe what's going to happen in the market as we're preparing for this intervention risk. The next structural catalyst is going to be the June 16th to 17th, which is the Bank of Japan's decision. So we're about 14 days away. Let the market show you its hand first. And remember that your patience is going to be the edge here. Most traders that are watching USD JPY at 160 right now are asking, should I buy? Should I sell? The right question that you should be asking and you should be studying for is, do I understand what I'm actually exposed to? That carry trade is the invisible thread connecting USD JPY to your stock portfolio, your crypto, and every risk asset that's in your account or in your portfolio at the moment. And when it unwinds, it's not going to unwind slowly. So that is exactly why we build macro awareness in every single trade, especially at SharmaFX. And it's not to predict the future, but to know exactly what the market is pricing, where the real risks are, and where the asymmetric opportunities sit when everyone else is pretty much caught off guard. So if you want to learn the full framework, how I build my macro bias, confirm with sentiment, execute on price action, I have a free trading foundations program in the description. It's completely free. There's no signals, there's no indicators. It's just the institutional framework step by step. And we also have our live Wednesday trading sessions every Wednesday at the market open at 6:30 a.m. PST. So if this video gave you clarity, hit like, subscribe, and drop your questions in the comments. I'll read every one of them and I'll respond. But June 16th is the date, so see you guys then.